Again, welcome to Philadelphia Apartment Network. Topic for this month is what the hell is going on out there? And you'll see why I use that phrase or question here in a minute. But first, a disclaimer. I am not an attorney, I'm not a CPA, and I'm not a certified financial planner. Everything in this presentation, while it's meant to be informative and educational or entertainment purposes only, please do not invest based solely on the contents of this presentation. Always consult your professional advisor when contemplating investments and their associated risks. So for the lawyer in here, does that clear me? I hope.
Yeah, I think that's pretty good. You're good.
I know I know it could always be longer, but I've seen some of these disclaimers go a page or two. So just try to keep it in general. Introduction, welcome to the Philadelphia Apartment Network. For those of you who are new, we've been at this going our 4.5 years now. I designed a group to build relationships, to either work with people or to help people invest in commercial multifamily properties so that they can create massive cash flow and wealth. Some of the promises I make to members of this group is one, to always try to be respectful of your time when we go to meetings, that we start on time and that we end on time. And then two, I promise to never make you a member of someone else's, some national guru's sales funnel. This is strictly meant to be a working group to try to achieve our goals in multifamily investing. So if that's what you're looking for, then I think we may have found the right spot here. So what are we hearing in the headlines today? And I've heard all kinds of things. Is the real estate market going to crash? Is COVID going to bust the real estate bubble if there is one? Is the housing market going to crash in 2021? And all these bubbles are going to burst. We're going to be seeing and hearing all kinds of tragedy. Get your dry powder ready to go and be ready to snap up all these properties. And well, and then I also hearing, well, we're having no problem collecting rents. Everything's just fine. Cap rates are going lower. Yields are going higher. So the real question is, if you watch a lot of sports on TV, they like to show this meme here. I don't have the animated version of it, but it's a picture of Vince Lombardi on the sidelines of a Green Bay Packer football game yelling, what the hell is going on out there? And that's sort of the right kind of question to ask for today's commercial real estate market. Just what is going on out there? So we're gonna look into it in 4 major risk factor areas. One is political, 2 is economic, the 3rd is capital, and then the 4th is, obviously because it's the big elephant in the room, COVID-driven factors that are impacting the market. And really, COVID is the big driving thing. Most of the issues that we're seeing in the market today are being driven as one way or the other as a result of COVID. So we can't ignore that is the elephant in this room. But from a political perspective, obviously we just had a campaign. And depending on what you believe or don't believe, I don't believe in getting political in this meeting. One way or the other, we're going to have an administration take over or stay in place in January. So the question is, which one is better for real estate or commercial real estate, Biden or Trump? And is that really raising a bunch of uncertainty? Well, Cushman & Wakefield did a study on that. And the report you can see here in the chart that you see on your screen, that commercial real estate has really performed well under either party. Growth averages over 8.5% annually under various Democratic and Republican administrations, going all the way back to 1979. What you see here in 1991, 92, this downturn was the dot-com bubble. And whoops, let me go back. And what you see here in 2008 and 9 was the Great Recession. So other than that, commercial real estate has done well irrespective of who's in power. So I would expect more of the same going forward. Part of it, but also from a political perspective, especially with this particular recession that we're in, is the political will to backstop the mortgage market. And if we're looking forward based on the kinds of things that the Trump administration has said that they want to do, and it makes sense from a Republican perspective, that does seek a smaller role in backstopping the mortgage market. I believe that isn't necessarily the president's personal opinion, but members of his administration have been saying this, and which could then place an upward pressure on mortgage rates. Whereas their thinking goes less government equals higher risk equals higher interest rates. Therefore, that the idea is to return Fannie and Freddie to the private market, um, put them on more stable financial footing, return them to private hands after imposing new limits on their business activities and raising the fees that they charge the lenders. From a Biden presidency, Ackerman out of the Wall Street Journal doesn't believe that the Democrats are going to have any plans to do anything with Fannie and Freddie in the near term. So either we're going to have a potential move of Fannie and Freddie going to the private market, which might increase interest rates, might not, who knows, or we're going to have more of the same that we have today with Fannie and Freddie backstopping the mortgage-backed securities.
Hey, Dennis, quick question for you.
Uh-huh.
Within that scenario, like which one do you think is better in terms of Fannie and Freddie?
I look at everything right now under the umbrella of COVID, and until we can have a lot of confidence that we've got that virus under control, I'd like to see things keep going the way they are. That doesn't necessarily mean longer term. I believe we should always be fully underwriting and guaranteeing all these mortgage loans and putting the government on the hook for that, because sooner or later someone's got to pay for that. But in the near term, at least under the aegis of the virus, it seems to be working well for a lot of the people who are putting the money up to make the loans, and it's certainly doing well for people coming in and getting very low interest rates for the properties they're buying.
Thank you.
Mm-hmm. Is that a non-committal enough answer for you? From an economic perspective, if you were on this presentation, if you were with us last month, we showed this chart last month as well. The idea that multifamily always does well in a recession isn't necessarily true. If you look here, you can see the dot-com bubble and that burst in 2001, and we saw vacancies rise quite a bit from just over 3% all the way on up a year or two later to over 7%. When we did the housing bubble burst in 2008 and 2009, vacancies rose from in the 5% rates up to 8%, which obviously when you get increase in vacancies in property, commercial multifamily properties, that doesn't do well for the value of those properties. And then we're starting to see over here in COVID, even though the numbers aren't all the way through 2020 yet, we're starting to see that. As you'll see, we're seeing more vacancies in the multifamily space. So keep in mind, government intervention and the economics behind multifamily are impacted by recessions. So how we respond as a country to recessions is going to determine how significant or not of a vacancy rate we're going to see in multifamily properties. What we're also looking at in general then, with the government backing all these loans and driving interest rates lower, and the monetary policy is almost near zero interest rates, that's why you're seeing commercial multifamily loans in the high percentage rates or low threes. It's driving the values of properties higher because you can buy more property for the same amount of money. So people are continuing to compete. As interest rates go lower, the prices of properties go higher. It's a good problem to have if you're an owner. If you're trying to buy, that's a different issue. Although you get to pay lower if you get the loan for it. But typically, on the upper left here, between Class A, Class B, and Class C properties, either in primary markets, secondary, or tertiary markets, you see this kind of a spread for cap rate. As of the middle of October, if you could please mute yourself, I'm getting a lot of background noise. Thank you. On the bottom right, these are the current cap rates as of the middle of October for the different apartment classes and the different market classes. and you're seeing a very close spread, and that spread continues to consolidate. I've been seeing tertiary market Class C properties going in the low to mid five cap rate range here lately. And the question is, are they really worth that or not? And we're going to see some numbers that might put some question behind that. So from an economic perspective, again, monetary policy can define how bad or good we perform during recessions. And it's also, from an interest rate perspective, going to drive a compression in cap rates as well. So let's talk about unemployment as well. Now, these numbers are good through October. I couldn't find the numbers updated through November yet. I don't think they're due out until tomorrow or Thursday. So I couldn't update this presentation in time to get those numbers in here. But as of October, the unemployment rate that you hear about on TV, which is, I think now 6.9%, is this number here of salary and hourly workers. This number is what makes up that percentage. What they don't report, but is also being paid right now through the pandemic unemployment insurance program, is for small business owners, gig workers, other self-employed people. There's another 11 million people who are unemployed, leaving a total of 21 million unemployed, at least through October. That now I'm hearing that number has come down a little bit in November, which is, any reduction in that number is good. But overall, if you count these two, instead of seeing a 6.7 or 6.9% unemployment rate, it's really in the 14 percentage point range. And what we're seeing is, with the CARES Act expiring in August, and right now with no replacement in sight yet, depending on whether Congress can agree or not. Unemployment benefits for these 11 million people go away in the end of December. Eviction moratoriums go away in December, unless they get extended, but I don't know that they will. All this is stuff they're trying to put into the next potential CARES Act, or whatever they're going to call it. And there's a whole bunch of other moratoriums that were put in place that are also going to go away on the same date, on December 26th. So the question is, what do we think is really going to happen, and how is that going to impact multifamily going forward into 2021? And the question also is, of these 10 million people here and these 11 million people, how many of them are going to be able to get their jobs back, especially in this 11 million person range? Because when we look at, apparently Yelp has been tracking since the virus started, the total number of small business closures. And I don't know how many they're actually tracking, but at least in this chart, they're tracking the closures since April through the end of August of 163,000 and change businesses. And we're seeing that's this number here. We saw a decrease into July of business closures, only to see it go back up into and through August. And now it's going up even higher, as we're seeing cities across the country start to reimpose more and more restrictions. So expect this 163,000 number to go up. You can see that a lot of them initially were closed in March, in early April, and they were viewed as temporary closures. But we're now seeing that a lot of those temporary ones are being converted into permanent closures. So I understand this number now is over 100,000 businesses are permanently closed. And the question is then, all those employees that were working there and all those business owners don't have those jobs to come back to. So then when we ask this question here, how likely is it that those workers are going to get their jobs back? If these are permanent closures, if this is a real number, a lot of folks don't have a job to go back to. And that's not counting the efficiencies that larger businesses are also taking, and they don't intend to bring back every employee that they furloughed or laid off earlier this year. So we're going to have fewer people working than we did at the beginning of the virus. From a capital perspective, how much money is there available in commercial multifamily and has it been affected? The answer is no, there hasn't been any real negative effect to the availability of capital. Money is available. And in fact, a lot of people took a lot of money out of the stock market and they have it sitting on the sidelines in what we call dry powder. And especially with the government backstopping or buying or guaranteeing Freddie and Fannie loans, and even willing to backstop and buy the bonds for the commercial mortgage-backed securities. There's not an issue with capital being available for loans for multifamily property. Now, we did see that Fannie Mae and Freddie Mac did place some restrictions or additional requirements on loans before they make them, but we're slowly seeing them repeal those restrictions and opening up more cities to where you can go back to an 80% loan to value and not have to put up a year, 6 months to a year's worth of principal and interest payments in a reserve account. But they are looking closely at underwriting properties on up to the minute rent collections, especially when you hear the Fed's, the head of the Fed, I forget his name, keeps saying that we need more stimulus because he sees a big wave of people not having the resources necessary to maybe buy, or to maintain their lifestyles, which would include paying rent, buying groceries, and the like. So he's trying to urge Congress to come up with a new support bill, and that may be this may be part of the reason why he's making those kind of comments in public. But what we're seeing, though, is that multifamily loan originations are down 21% year over year, down to 288 billion from 364 billion last year. And this number would be lower, but there's a lot of people who have properties today that are refining. So that counts as a loan origination. A refi counts as a loan origination as well as a new purchase. So we're seeing that new purchases, multifamily sales, are down 41% from this time last year. So money is available. Fewer people or fewer properties are actually trading. And that points up to a disconnect between the sellers who are saying, hey, I didn't really suffer during the COVID shutdown and through the summer, so I want top dollar for my property. And we got a lot of buyers who are saying, wait a minute, I still don't know what's ahead of us, and we need to buy it at a different price. And there's a mismatch in expectations that just isn't being bridged, obviously because we're down 41% in sales. The third quarter of this year, commercial multifamily mortgage loan originations just in the third quarter were 40% lower than compared to a year ago, according to the Mortgage Bankers Association. Now, if you're into commercial real estate in general, here's sort of the rest of the categories and how much the actual loan dollar amounts are down by each of these classes. And I think we all can tell for sure that hotels, they're down 94%. That's outrageous. Same with a lot of retail. And in fact, here in Chalfont, where I do my grocery shopping, is a large retail shopping center there with probably 30 different storefronts. As of the end of January when I was there, it was 100% full. Last week, I drove through the parking lot again and saw 6 empty storefronts. So just through the pandemic, this one shopping center alone has lost 6 out of 25 or 30 different storefronts. So it's hurting everywhere. And I can understand why then retail purchases are down. And then you can see the rest of them here. And these are dollar values, not the number of sales. So let's talk again now. We've gone through the political aspects, we've gone through the economic aspects, and we've gone through the capital or the money aspects of this. Now let's talk about the COVID-driven impacts. This is sort of my perspective, and there are others out there who are saying the same thing. The multifamily is still sound, but there are cracks in the wall, and we're starting to see some of those cracks widen a little bit. But we're seeing geographically mixed results, which is why it's hard to make a declaration one way or the other that multifamily is still the best investment vehicle or there's problems with multifamily. I think Roman mentioned that he's seeing people leave New York City. That's very true. There is a trend of urban flight, although you may be surprised that it isn't strictly due to COVID, but COVID has certainly helped move that process along. Um, Philadelphia is seeing an exodus from the center city area a little bit, and it appears apparently that most of them are moving out to where I live here in Montgomery County. I actually live in Montgomeryville, right next door to Lansdale there, and those two are seeing the fastest rent growth in the metropolitan area. So too bad I don't own property here. I could charge more rent. What we're seeing is a number of the larger gateway cities are showing significant increase in vacancy, and therefore they're offering a lot higher concessions. And we'll talk about that more in a little bit. But as a result, though, those people have to live somewhere, and we're seeing more affordable markets and smaller markets are actually where those people are moving to. And we're seeing rent increases and a reduction in vacancy in those areas. And in fact, nationwide, suburban rents are up 0.4%, while urban vacancy is up 7%, with the national average being just over 5%. So the urban cores of the largest cities are being hit pretty good right now, but the people benefiting from them are in the suburbs circles around those major cities. They don't all move to the Poconos, but some of them are. So as Roman can attest. Now, what is that going to mean though overall? As if you look here, the Fitch Ratings recent report suggests that those people or those companies with a high exposure to Class B and C assets and properties in gateway cities are vulnerable to the continued economic fallout that we talked about with unemployment and other aspects to the coronavirus pandemic. And therefore, due to the risk of urban flight and high job losses among lower income households, we'll talk about, is going to impact property performance owned by people who are in those markets and with those class of assets. Redfin reports that 39% of renters lost wages so far since March, which is a lot. Now, 30% of homeowners lost wages as well. So there's still pretty big, to some degree, it's still pretty big numbers, but renters are more susceptible to wage loss overall. The service sector lost 3.2 million jobs, which is 18% of the total renter base, and 35.2% of people in the arts, entertainment, and recreation center lost wages. And the question is, how soon will they get those jobs back or wages back, if they'll get them back at all? We don't know. And as you saw from the Yardi or the one chart on the number of businesses closed permanently, it's going to be harder for these people to get those jobs back. And here's a chart that you saw last month as well. It shows that millennials are leaving the urban core. It's not just anecdotal evidence, it's actually happening. And these are just 4 of the large cities where you can see that. But if you notice, it actually started a while back. It started 3-4 years ago. And COVID has just accelerated the pace of departure. But what's happening in the top 100 markets? There's been a big change in what's been happening from last year to this year. Last year, only 5 of the top 100 markets saw rent decreases. So far this year, and we're not even done with the year, 41 of the top 100 markets are seeing rent decreases. And this is important. If you remember last month, we went through a spreadsheet analysis to show how much value properties can lose as a percentage of their overall value based on a number of factors, and rent decreases was one of the big contributing factors. In fact, we were able to show easily that one apartment building could lose 40% of its value just through a couple of small changes in things like rents, concessions, vacancy, and the cap rate. And you don't need to see big changes in order to affect a 40% decrease in value of your property. If you're interested in seeing more detail on that, if you go to my YouTube page, you can see that presentation. It's out there for anyone to view. We did see 63 of the top 100 markets saw rent growth slow down year over year. So for those places that haven't seen a rent decrease, we're not seeing the 3, 4, 5, and 7% rent increases, that we would love to be able to show to potential investors. We're seeing things between 0 and 2% in a lot of places. Nationally, rents are down as an average 1.7%, which is the first time rents have been down since 2010. And you can see here some of the major cities, how much they're down as a percentage. But there are some markets, like I said, if you go to smaller, lower cost places or some suburbs, you can see that rents, there's a rent growth as well. So it depends on where you're looking for. I would say right now, if you're looking in multifamily for the next couple of years, I would not necessarily be looking in the urban core. Be looking in the suburbs and or some of the smaller, less expensive cities. But that will change. Like everything, real estate is a cycle. And right now, the urban cores may be suffering, so there's going to be a time to go back into the urban core and start buying. The question is when that will be. And if you've got a crystal ball that can show you that, please let me know. I'd love to see it. Concessions. We talked last month about concessions as well. I mentioned there was one Class A asset that just delivered here in Philadelphia, and they're already offering up to 4 months of free rent as a concession. Property owners are trying to counteract the effects of the virus. And we're seeing this year, we expect to see in 2020, 450,000 new Class A assets come on board. So concessions offered are increasing. They're up $6 million so far this year, which is a 42% year over year increase. So the cost of doing business just to attract renters or to retain renters, it has gone up 42% from last year. Concession values just since April are up 82%. Now, obviously, that's a smaller number. That's not 6 million, but that's from where we were in April to where we are today. There's been a big jump, and most of that has happened since August when the CARES Act expired. That's when it started really looking to hit property owners in the pocket. And you can see the breakdown by Class A, Class B, and Class C concessions since April of this year to where they're at today. Fannie Mae says that higher Class A concessions, which we're seeing here, this 9.2%, is going to force Class B and Class C properties to also offer concessions as people are looking to move and are looking for affordability. If there's concessions in a market, everyone's going to be looking for concessions. And again, you can see from the large markets, what are the increases as a percentage of concessions. And in fact, Roman, for New York City there, just in October, there was a 2.8% increase in the value of concessions, which has been the 10th straight month that there's been an increase in concessions in New York City. So I can understand a lot of property owners up there may be concerned. That I've wondered why I've seen a lot of properties come available for sale lately up there. And this sort of answers that question. And Alicia, even Phoenix is offering concessions. As hot of a market as you're in today, you're starting to see concessions out there.
Yeah, yes, we are.
I think this is the second to last chart, so we're almost done here. Rent collections and loan collections. Really, the reason why we're seeing such a mismatch between the people offering properties for sale and the people who are actually able to buy them is because due to government stimulus, rent collections have sort of been almost where they've always been. They've been just slightly below historical numbers. They've only been slightly down. However, rent collected since March is down 27% overall. But because the government was giving excess unemployment or extra unemployment benefits and stuff, people were able to prioritize their rent because they had enough money coming in to pay rent and to pay food and all the other bills that they have to pay. But now, since August, since that's gone away, we're starting to see more of a drag on property performances due to non-payment of rent. Moody's Analytics also says that in the third quarter of this year, rents decreased also. In order to bring in new tenants or new renters, we're starting to see property owners have to come in a little lower on rents, which they really hate to do. That's why concessions have been so high, because they want to still be able to say on their books that, let's say a property goes for $1,000, I might offer you a free month's rent as a concession, or even 2 months, but I still want to be able to charge you, say I charge $1,000, because that affects the reporting value of the property. But now we're starting to see, on top of concessions, or we're starting to see rent decreases as well. And this is the biggest decline since 1999. Historically, rents have never declined by more than 0.7%. So almost a 3% increase in the rate of decline of rents. However, the good news to that is, though, a lot of tenants, because of the virus, they're afraid to get out there and move around. Tenants are renewing at a higher rate. Retention rates are in the mid to high 60s, 60% right now. You might typically expect to turn over 45 to 50% of your tenant base in any given year. So a 10% increase in retention is good for the property. That's a reduced expense. The question is, will that be able to be maintained as the eviction moratorium ends and as unemployment value, benefits end? Are we going to be able to retain tenants, or, just what is the impact of evictions going to be? I don't think we really know. And different states have different processes that homeowners or property owners have to go through. So I don't know that it's going to be as horrific as people think it's going to be. I think it's just going to be more dragged out. So we'll see what happens there. But two pieces of information here I wanted to touch on as well is all that dry money, all that dry powder that's sitting on the sideline. And we talked about it last month as well. There's billions of dollars waiting to look for an opportunity, either in real estate or elsewhere, sitting on the sidelines. So everyone was thinking they'd put a bunch of money together, and then they'd wait for all these properties to have trouble at the bank, and then you swoop in and buy up properties. Well, we're starting to see that that's happening. Not that they're buying them up, but we're starting to see people being late on their loans now. Freddie Mae and Fannie Mae and Freddie Mac, I get those two confused all the time. Agency loans, late payments are up almost a full percentage point to 1.4%. Of all agency loans now are late, compared to just 0.46% in August. So between August and November, we've seen a 1% increase. Non-agency backed loans are up almost the same percentage, the same 1%. They're up to 2.78% from 1.83. So the question is, as COVID and the economy continue to drag and we start to see an increase in expenses, sort of view it like the tide, right? A high tide hides a lot of garbage in the ocean. A low tide tends to let you know who's wearing a bathing suit and who isn't, so to speak. I don't know the exact verbiage of that statement, but what we're starting to see is what we're seeing here is apparently there's a number of property owners out there that didn't buy well, and enough to be able to weather the downward economic experiences that we're living through today. So banks are going to be looking at finding other buyers for these properties before it gets too bad. The question is, how much higher will this 1.4% and 2.78% go up, if it goes up much higher? And then what are the bank's activities going to be? And this is where we talked about it last month. When you start to lose value in your properties, you start not being able to maintain the technical thresholds that the banks want to see as far as your ability to pay back the loan. So you can be in technical default, even though you might still be making the payments, or in this case, they're not even making the payments on time, so they're in actual default. And as that number rises, the banks are going to be looking for other buyers. So that's an opportunity if you have the money behind you already to go. But it's going to be a slow drip. It's not going to happen. It's not going to jump from 1.4% to 3 or 4 or 5% overnight. It's going to drag out. But the potential for it to happen is there. So as you're going forward into 2021, if you can make sure you've got your investors lined up, and you can present yourself to a bank that you can responsibly run a property, then you may find more and more of these kinds of situations. I think one person on here and I are looking at a property now that may be in this situation. So the question then is, what's your strategy to deal with those sellers, who are still wanting to get top dollar, but obviously can't continue to support the property. And how do you bridge that gap? So in summary, we talked about four main risk areas. Political party changes in the White House seldom affect commercial real estate returns. However, the government's response to recessions and monetary policy to help deal with those recessions can and do affect or have an effect on multifamily values. Business closures will have a longer term effect on employment, and I think it's going to be a drag on the economy going forward. If we're starting to see 100, 140, 150,000 businesses shuttered for good, that's a lot of people out of work who have to now go find work elsewhere. On top of that, with the virus's apparent resurgence, it should continue to inhibit or prevent economic recovery in the short term. Even though the stock market may go up, that doesn't mean that translates into jobs. So then the big question is, will there be more stimulus or not to help soften the impact of business closures, or will it not? I don't know. Again, whoever has that crystal ball, I'd love to see it. Capital is available. Problem is, it's got nowhere to go because there aren't enough acquisitions happening. And then multifamilies are being impacted by COVID-19, forcing them to offer greater recession or concessions, lower rent rates, and we're also starting to see that they're having a harder time making their loan payments. So with that said, that's all I have on this presentation. Is there any questions, concerns, comments?